Good morning, traders. It is 8:03 a.m. Chicago time on Friday, the 2nd of September 2016, non-farm payroll day. Thanks for joining and happy Friday. Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not indicative of future results. So the headline, of course, unless you're asleep at 7:30 Central, 8:30 Eastern, the headline is non-farm payrolls came in at 151,000 versus 180,000. This number was extremely important to watch, for the market to watch, as the Fed was indicating that it's watching what the economy is doing, and this is a major number. This is the key number of the month, in addition to the FOMC release. Overall, the unemployment rate went from what came in at 4.9% versus 4.8 expected. Underemployment rate 9.7% in line. Average hourly earnings came in at 0.1% versus 0.2, slightly worse. Year on year, 2.4% versus 2.5, slightly worse. Average weekly hours 34.3 versus 34.5, also slightly worse. And the uh, the thing to take away from this is before this number, I spoke about this earlier this week. December was expected. A rate hike was priced into the Fed funds rate. This is essentially participants betting on a Fed rate hike in December at 64%. That dropped slightly this morning to 59%, and then it dropped after the number to 55.4%. That's the chance that's priced in that the Fed funds rate's going to rise. But for September, it went from 36% approximately pre pre-release to 22% after the release. As you saw, the number came in poor, but it also caused the market to rally. I'll go over the technicals here, but these are important things to note. Average hourly earnings have been falling, actually. If you look at the long term, the average hourly earnings have steadily fallen. With business delinquency rates rising. So it's just a mishmash, a mix of things. It's really hard. I'm not an economist or an analyst, but I don't envy those guys. Really hard to read into what is going on overall, in my opinion. But I'll go over the figures for the non-farm payrolls in just a minute. The news overall was anchored on this non-farm payrolls release. However, we also got construction PMI out of the UK, and it's showing slight improvement since Brexit. The construction PMI came in at 49.2, substantially above July's 45.9 print. It's a big expansion there. The British pound is unchanged, although it's slightly stronger at $1.3270. At $1.3270 per pound. The majority of Scots in a YouGov poll that came out yesterday, the majority of Scots are seeking to remain in the UK. 54% are voting, or polled are voting to remain. And then other than that, there's really nothing major to report. Looking at the rest of the day, with not NFP behind us, we're getting durable goods. We're actually getting ISM New York, which is not a major mover. ISM New York is expected to be out at 8:45 Central, 9:45 Eastern. Durable goods at 9 a.m. Central, 10 Eastern. The expectation here for the final number for July is 4.4%. One other thing to note about non-farm payrolls: August has traditionally been the worst month for job creation. However, we need to pay particular attention in October's release, the first Friday of October, we need to pay particular attention to the revision of the August number when the September number comes out. It's very important to keep that in mind, not to take the number as it is, but also look at revisions. Again, 9 Central durable goods, and then we're getting factory orders as well, expecting 2% for July. That's also at 9 Central, 10 Eastern, and then of course at noon Central, 1 Eastern, we're getting the Baker Hughes rig count. As far as speakers, not seeing not seeing anything of significance until noon Central, 1 Eastern. Fed Speaker Lacker speaks on the interest rate benchmarks in Richmond. That might be a mover as well. So that's how things are laying out. Let's take a look at what we planned for yesterday. Here's the plan for yesterday. The expectation is the market would open in a sideways, choppy market, wideish rotations, and to test higher. The test is expected to be at the value area high area, which is also July's high, which is also the MCLVN. So that area is about 2173 or so, or 72 and a half. And then the expectation is it starts to roll down and get down into the 2160 MC point of control. The reason for this expectation yesterday is the one-time framing down. The market is cruising down, has a trend going in the downward direction. One-time framing simply means lower highs, which started where the arrows are seen here, lower high, lower high, lower high, lower high. With with a break higher being one that might push the market pretty strong out of this area and straight into 79 and a quarter. The secondary hypothesis is a fairly choppy open again, wide rotations, looking for a test down into the 2165.50, and then looking for it to start breaking the one-time frame with the primary target being 79 and a quarter. It's about 14 points of range. That was the second hypothesis, which didn't work out. This is what it actually looked like yesterday. Yesterday we pushed right up into that. The high of day is basically 72 and a quarter. We pushed right into that value high right here. Test the value high right off the open, and then we started to rotate down, and then we just couldn't breach back in. This is the first opportunity for short at the open, OS low, mid, VWAP, and the LVN from the prior day. A lot of confluence there, a fair amount of heat, about 5 or 6 ticks of heat on that trade, but it finally gave. And then the target for this trade was the prior day's low and this MC point of control, 2160.75. That was the key target for that trade, and that was worth about 7 points. And then the market, had this impulsive move, continuation. Then we went and retested the IB low from below. A nice little test here. And then we had a higher low, and then we went into a corrective mode. There was a big impulsive move up, and then the expectation is for a continuation higher. The market got shut off by the open yesterday, again retested lower, and looked like it would be attacking that 2160 and the IB low again. And then on the close, we had buyers come in with some pretty good delta there that looked like squaring up risk ahead of the non-farm payrolls, really more than anything. That's how the day worked. Hypo 1 up to this point was Hypo 1 was right on. So this plan played out fairly early. The most probable expected plan played out. That the week hasn't been like that, but yesterday it did work out that way. Yesterday, I want to point out, like I did in yesterday's webinar for Stage 5. Let me turn down my news feed here. A lot of chatter. The market, yesterday's trading made distinct. This is almost like out of an auction theory textbook, the market yesterday made distinct balance zones and imbalance zones. So what it did is it tested higher earlier, and then it made this balance zone right there. Then balance led to imbalance, which is where a trend is formed. This is the trend down. Then we have balance for a little bit. Then we have a trend up, and then we rebalance. Where do we rebalance? Right inside of this range from above. Very methodical auction there. So we had basically two distinct areas that the market's accepting. We saw that it built this double distribution. Um, this is a very this is you don't we have not seen this since probably May of this year, where the market is auctioning properly. And we have some pretty good range expansion here on the prior day. Yesterday overall was a fairly decent trading day, in my opinion. Doesn't mean that you make money on those days. It just means that the opportunities are a little bit better or easier to read. Whenever there's more opportunity, there's also a higher probability of risk. Just those things go hand in hand. So that's the recap of yesterday. I did not see this. I did not see this push up coming. I was more interested in the drop per hypo one, and the reversal here didn't end up playing hypo two, which is basically sat in the middle and closed right inside the IB. This is what's called a normal variation day, where the IB high stayed intact, the IB low broke, and the market closed somewhere in the middle. This is the most common day type when we classify the market in a market profile sense. Couple things to look at. Here's your non-farm payroll. So we've got, this is basically this is yesterday's profile right here. This box is yesterday's profile, and everything that is gray and blue is the overnight session or the Globex session. And you can see that it's really super dead through the Asian session. We had some figures through the European session, so we had some range expansion in the European session. But overall, the planet was waiting for this non-farm payroll figure, which showed up right here. I posted the key numbers from this earlier on. The scene of the crime is at 65, 21, 65, 75. Those of you who use flex levels will see the levels adjust to that. 2165.50 is the non-farm payroll low, and 2175 is the immediate high following the non-farm payroll. What we had is an impulsive move. We had a pullback, and it struggled, but we're finally getting the continuation right there, and we're pushing against prior or the overnight high, and we're starting to push the prior day's high, 2177, or a few days high, 2177. Today looks like it's likely to reverse to end the one-time framing down, and then then what we have to do is start looking at the MC point of control up. But that's what we gained from this morning, is something to pay attention to. Any retests, any initial retests of this area down here, 2169 to about 2170, 71 or so, is going to be very, very important. There's a lot of confluence in this area. I'm going to be watching carefully for what happens if we decide to pull back to this area for an opportunity for a long back up into the upper balance once that forms after the open. If you don't understand what I'm saying or what I'm talking about, and this is all new to you, just hang in there. Over time, it'll start to percolate and sink in, and it'll make sense. The way I'm organizing the market helps us keep a strong hand on our trades once things start to make sense. This is the 10-year note. The 10-year note is, of course, a treasury product or an interest rate product, and is highly affected by what the the Fed does. And you can see it opened. The pit session opened at 7:20 Central, and the number came out right at 7:30, and at 130.29 half is the SOC here. You could see that the 10-year pushed straight up, pushing yields down on the 10-year note. It pushed straight up, but it came and it took all of that back. It actually bounced um, right off of the 130.29 half. You can see that figure there. That is exactly the SOC for the 10-year note. The bounce from 29 and a half to 01 half, and then this market is pulling back. Now, note that it moved with equities on the upside. It moved with equities on the upside on the release and has taken all of that back. Yet the equities are still holding on to overnight all-time high or overnight highs, and the action is supposed to be this way. It's supposed to we're expecting funds to move out of risk or into risk, and so now the 10 years back in line with what the indices are doing. But I find that it's odd that it pushed straight up. Yes, I expect that for yields to go down, prices need to go up on the note, but this is essentially bringing yields back to where they were before the release. I'm keeping an eye on this terribly weak low here. This is likely to continue lower. The next test area for the 10-year is likely to be this price down here, the HVN from yesterday. So an interesting product to watch. The 10-year note, it's been moving around pretty decently. Now, looking at where we are where we've been over the last few weeks, you can see that we pushed up, we gapped up back on the 12th of July and have been in this tight range for quite some time. The market has loosened up a little bit the last couple of days, but overall it's been a pretty tight, tough trade this summer. I haven't seen it this tight in a while. Yesterday we expanded a little bit down. We did not quite get to 2153.75, which is the next key area down. But overall, the market is likely to pull back. So you could follow the VWAP line here. The VWAP is this bright cyan. You could see how volume is moving, and overall the trend has been down. And today is essentially breaking that. It's pushing higher. We're trading against the all-night high, the overnight high at 76.75. And we're reversing that. So I expect the market this morning to open. I'm looking for an immediate push to 79 and a quarter. I'm looking for it to fight 79 and a quarter, make an attempt to push down. But overall, I'm expecting the market to hold these prices up here pretty much all day. That would be hypo 1 for me. I'm not looking for the market to roll back over and retest below. Why? Because we are ending the one-time framing down. There's a lot of incentive for people to buy today, in my opinion, for this to be supported as they cover their positions. It's also this also invites the buyers, the bulls, which have been dominant for months now, to step back in as the short time frame, the short-term trend down is coming to an end. So hypo 1 is looking for wide rotations, an open auction out of range, imbalance, and then I'm looking for it to get tangled up in 21.79 and a quarter. If it happens to release, then we have enough room here to start pushing towards the all-time high, with 86 being a potential pit stop. The secondary hypothesis is we get responsive. This is not really expected. I'm looking for an open auction out of range. Test 79 and a quarter, put in a lower high, and start moving back towards the 72. I expect a small bounce at the 72 as I showed you in the overnight session, and then the target becomes 66 for 13 points. That would be hypo 2. So for hypo 2, what am I looking for as the market trades? I'm looking for any tests higher against 79 and a quarter that fail back through. So I'm looking for any structure that is attacking the gap zone below after the market puts in its opening swing. Again, if you don't understand any of that, just hang in there. Maybe get on futurestory71.com, find the video archive, and watch some old videos to understand the lingo and all that. I'm sharing a lot here, but it is likely to be active right at the open. But it's Labor Day on Monday. Labor Day holiday on Monday. The equity markets are closed. The futures markets are open till noon Central, 1 Eastern, and it is Friday. It is the last weekend of the summer. Schools here in Chicago start on Tuesday. Expect traders to walk out and start their weekends early today. So I'm looking for the first 2 hours to fulfill whatever the mission is for the day for the higher time frame, and I expect it to get really choppy and quiet later in the session. Good luck today, and hopefully you're finding this useful to you, and you're picking up at least the idea that you need to come in every day with a plan that includes several alternatives for what you'll do when you see what the market is doing. Good luck, and I'll catch you on Tuesday. Take care.